Of course, this is not financial advice and for entertainment purposes only.
Investors, welcome the one and only Jordan from Cover Call ETF Investing on YouTube as well as on Blossom. Now, if you guys want to see Jordan's and my portfolio on Blossom, it will be in the link in the description of this video and in the pinned comment section for free. Now, Jordan's Blossom bio says that he is a cover call ETF investor earning just under $5,000 per month in distributions, or should I say dividends, but let's go with distributions and premiums, where his goal is FIRE by 45, where Jordan is just 35 years old. He has a portfolio of just over $360,000 verified by Blossom, where Jordan is earning, once again, just under $5,000 per month in distributions. And he is earning as well as just under $60,000 per year in distributions as well from his passive income cover call portfolio. I must say, Jordan, that out of everybody I know, that you are one of the most knowledgeable and underrated guys on YouTube, as well as on Blossom for cover call ETF investing and everything passive income investing. You're going to see that Jordan's portfolio is up in the green with no NAV erosion, having positive returns, and on Blossom, you will see over 20% gains, but that does not include the income, the distributions, the premiums. So Jordan is probably up way more. Jordan's distributions have increased month over month, which is super rare in my opinion for a cover call passive income portfolio. So Jordan is defying all the odds with his portfolio. And fun fact is that Jordan sold his condo to upgrade to a townhouse rental and use that money to invest in cover call ETFs. So Jordan is all in on cover call ETFs, hopefully in a very sustainable and a long-term manner. So Jordan, how do you feel about being on the channel and just your portfolio in general?
It's a pleasure to be on the channel. Happy to be here, and the wealth of knowledge that I hopefully have that can be spread for the audience here.
First question for you, Jordan, is can you introduce yourself as well as give us a brief overview on how you got started with investing, especially in cover call ETFs, and how are you here today with an over $360,000 portfolio with over 60, or should I say just under $60,000 per year in distributions?
I don't have a finance background. I'm a ticketed plumber up here in Canada with a red seal. So a red seal tray can work all across Canada with that red seal ticket. I live in a suburb of Vancouver, and I got actually started investing just before the age of 31. And somebody I work with who's been a tremendous mentor of mine, has a multi-million dollar portfolio himself, owns all kinds of real estate across Canada and the US, but yet still a pipe fitter coming to work to a shipyard every day where we build Navy vessels, Coast Guard vessels for the Canadian government. Jordan, do you know what a dividend is? You got to get investing. And I just kind of put it off. To me, I would see the chyrons on a news network where it was like squiggly lines going down to the red. I just figured that's just so crazy. That's not for me. Through just reading, and he gave me some books to read. The first book I read was The Intelligent Investor, which I got to say it's a textbook. It's maybe not the first book I'd ever start out with, but nonetheless, I read it in 3 weeks. Had no idea what I was reading, really, but I just circled, benchmarks and quotes and formulas, and I started to form the backbone of how I thought I would value companies. I got started with, if you're a Canadian investor, typically you're going to get started with a lot of dividend-paying Canadian stocks. Maybe about a year in, I started reading about these things called cover call ETFs. Once again, just kind of similar to the red chyrons going down, I figured, well, I've heard that high yield stuff isn't safe, so I'm just going to stay away from that. But I kind of kept coming back to it, and I kind of kept reading about it, and it just, it started to interest me. I didn't know really why. I couldn't really fully explain the thought process, but anyway, it was just really interesting. I read so much before I ended up following anybody. And actually, the first guy I followed is probably someone that almost nobody has heard of. The guy's name is Nick LaForge, but little does he know that that was kind of the gateway drug into cover call ETFs with things like XYLD. So I bought XYLD because he owned XYLD in my early investing career. But it came off because of just because I was really interested in it. Formulate a strategy around sort of my lifestyle, which I have kids, I work full time. There's overtime. So I wanted a portfolio that I could be fairly hands-off, not make any super significant moves. I was newer, so I knew I would probably still make moves, but I just didn't want to make them too often. So I wanted to stay fairly indexed, or at least with products that are closer to an index. Yeah, I just ended up for the last couple of years just contributing $1,000 every month. Anytime I could scrape by a little extra cash somewhere, I would just contribute. And, the markets overall have been pretty friendly in that regard. But I think the key for me was, yes, I'm interested in cover call ETFs, but I also want that upside as well. So I want products that have that ability to naturally grow. I still get a really nice yield, but I still wanted to naturally participate in markets.
You would say that you are a cover call passive income investor. What are going to be 3 reasons as to why? Is it the high yield? Is it the dividends, or should I say the distributions? Is it what are those 3 main reasons?
The number one, I think with any investment, do you have interest in it? I have a family member who's brilliant with Bitcoin, right? He speaks at conferences about Bitcoin, doesn't have a channel or nothing, but brilliant. And he's peppering me with, you got to get into Bitcoin, but I am not interested in Bitcoin. I'm not. And here's the thing. I think my education in finance, I think would be pretty subdued if all I did was invest in something that someone told me to invest in. If someone just told me to invest in strictly a plain vanilla S&P 500 ETF, I don't know if I would have the same kind of hunger to learn more about finance. I'd probably just stick my money into it and kind of just forget about it and maybe just contribute. And that's fine for certain kinds of investors who just want to be even more hands-off, but I wanted to learn more. So I think that was one. It's just cover calls just naturally intrigued me with these higher yields. I was told they're dangerous. So I think, from that perspective, I wanted to know more, what makes them dangerous or whatsoever. So, in my learnings, I found out, okay, they're not, but I think you just got to go a little bit deeper. So I think the one was it was just intriguing. It was different. I could be indexed to the S&P 500 with a strategy like cover call ETFs. I could be fairly hands-off. So as far as a time commitment was concerned, that would be one. Of course, the distributions themselves, I looked at it as a way to start chipping away at my paycheck to replace it little by little. So, if you think of that paperback paycheck of old, it's just you're kind of almost ripping it apart, and you're kind of moving those pieces over to these these high yield ETFs. So for me, I really like that idea. It started to come together more naturally that I could make this actually work way ahead of schedule. A drive to be able to share that with others. Once you have the realization, I wanted to share that on a platform, say like YouTube, and try to share with others what I have learned, what I'm learning, and take people along for that journey. And I mean, even on my own channel, I have, the post section. Guys, you can see, I think I'm 90 weeks in with posts week after week after week, where you can actually just scroll through and see how my portfolio has grown. You can see the dividends, you can see the portfolio growth, the performance against other indexes. And I just wanted to make it absolutely clear, transparent for everybody that I'm all in on this stuff. The highs, the lows, you get to see what this journey is like investing in these products.
Can you give me a rundown of your portfolio? Because you said that you love being index-based. Now, for those watching, that means investing in S&P 500 and NASDAQ 100 for the most part, cover call ETFs. So you basically invest in an index, and then they sell or write cover calls or call options against the underlying holdings to generate monthly and or weekly income. Jordan has all Canadian ETFs, to my knowledge, but I did my own research and saw that there are some equivalents like QQQY, SPYI, JEPI, GPIQ, GPIX, and T-SPY for Americans, so keep that in mind. Why you like being index-based versus we all know those single stock cover call ETFs, like your MSTYs, like your NVIDIAs, like your MST, MSTW, like all those single stock funds, Pelty, like all those single stock funds, but you are index based.
So the reason I wanted to stay, again, index based is I got a busy life, work, family. I got 3 kids. I'm married. We're a single income. Life is crazy. Even, the lead up to this interview, it was like, I'm just washing dishes and kids. And it's like, then I sit down with 5 minutes to like get organized on the computer here. So I need, again, a portfolio that is suitable for the kind of busyness that I have in my life. So to me, the best way for me is just to stay index. As long as I'm bullish that the economy will grow, I want products that will track the overall economy with some light exceptions in there, but nothing too crazy. So that is honestly, to me, one of the best ways to invest. Not every product I have is an index. It might be something that is say invest in many sectors, but is not tied to an index whatsoever. And when I run down my portfolio, I don't have any single stocks in it. I got into ETFs and away from single stocks. The kind of work that at least I think that needs to go into researching individual companies is just not suitable for my time commitments or time constraints. Learning about income statements and balance sheets, cash flow statements, learning about qualitative and quantitative metrics, right? We can even get into Tweed factors and Graham ratios. And so there is a lot there when to truly understand what a single company is and what it does. Your circle of competence, as Warren Buffett coined, is a single stock in my circle of competence. Probably not. I don't have the time for it. I really don't understand a lot of companies. But what I do understand is a combination of stocks in one place that I think will be beneficial to the macroeconomic environment, for the entire economy. So ETFs are a much easier way, I find, to take advantage of growing my money. And maybe it's at a slower pace. We all know single stocks, because they're so highly concentrated, they have the best potential for outperformance. However, unfortunately, everybody getting into single stocks doesn't really understand what they're getting into. They see it more as maybe a swing trade. Let's just take MSTY, for example. Well, MSTY holds Bitcoin. Bitcoin's going to go to 1 million, so therefore I should invest in MSTY. Well, that is one way to play it. That's fine. But I find with just individual companies, you probably need to go a little bit deeper than just that alone.
Talking about single stock cover call ETFs with the potential to outperform, I know I like to push your buttons a little bit, but sure. What about thought of, hey, MSTY, Pelty, Hui, they're up like 100+%. Do you feel like, oh, should I chase that ETF or should I just stick to my index-based strategy for what's working? So do you feel like you're missing out on those gains and opportunities, or do you feel like, nope, I'm fine, I'm going to stick to my index-based cover call ETFs?
Yeah, every once in a while I might get this question. And honestly, no, I really enjoy my strategy. Again, it's understanding, how can a portfolio best suit your needs? What is best for you? So, when you truly understand what is best for you and the kinds of investments to support those goals, you're going to have a conviction like no other. It doesn't really matter what anybody else says. It's just like nobody else knows you better than you. So if you're a newer investor, this now takes some experimentation because you're trying to get a little bit more experience. And so if you're investing, in single stock cover call ETFs, or maybe some other exotic funds that just pay out, the 100% yields out there. I understand that if you're younger and you're trying these things out, keep in mind that if you are younger, I almost certainly guarantee you will change and your needs will change, especially as you get into your career, you get married, you have kids, you need to buy the house, you want to go on that vacation, you will change. And I think it's simply just be open to that. I got invested when I already had a condo. I already had, I was already married, already had kids. So in a way, it was a little bit easier because I had all those things already set up. I didn't have to pick and choose and strategically allocate money to these other things. I could just start investing. So maybe a little bit easier on my part, but if you're a little bit younger, just be open to that and just understand that change is possible. So do I feel like I've missed out on gains? Not at all. I don't chase gains whatsoever. I think my portfolio speaks for itself, right? I'm still capturing upside. I sleep at night because I'm spread across the entire economy. If Hui goes down or something else goes down, honestly, I'm not worried because just something else will take its place fairly easily.
On Blossom, Jordan's dividend, or should I say distribution yield, is 16.42%. So fun fact, that is one of the lowest, fun fact, that's kind of funny to say, the lowest cover call ETF yield, because that would be considered high for dividends, or should I say distributions. But you have, once again, no NAV erosion. Your portfolio is in the green. How do you feel about that yield being 16% compared to maybe other yields that are 50 to 100% with the craze in the high income space? But I want to throw it back to you.
Certainly over the last, couple of months and maybe even the last month at time of recording, there has certainly been not a renewed interest, but maybe a surge in interest in extremely high yielding products. I think that, and you're seeing it with content. So and social media as well, there's just more chatter about it, and therefore more investment dollars are flowing to that. Obviously, now that I've been investing in, I'll call it indexes or sort of proxy index cover call ETFs, at times I kind of feel like, I might be the dinosaur now. Whereas, maybe when I started, me investing in 10 to 12% yielders was seen as like, that's insane. Now, and I talked to Sai Katara from Tap Alpha about this, 10 to 12% now, with the maturity of this space, is now like fairly routine. It can be done. And you can also still get that upside, whether you're looking at, say, like a T-SPY or a SPY-I from Neos, and with the stable distributions. Underrated funds from a yield perspective, but the powerful funds when you want to try to capture a little bit more upside with the price appreciation. And I think the cool thing is when you're able to also have some sort of level of focus on price appreciation, instead of just, rooting for that 1% or 2% or 3% per month, you're giving yourself a chance every single day to get that maybe 1%. 0.5%, 0.2%, but every day you're giving yourself that chance for that upside versus simply that maybe one distribution per month, or sometimes if it pays weekly, the 4 times a month. And of course, as we know, sometimes during the year, there's 6-7 days you really don't want to miss out on. That inflation report recently came out this past week, and that is one of those days you don't want to be missed out on. And I got to capture a ton of upside with the pricing in of potential interest rates that may occur in September.
Do you prefer weekly income or monthly income?
I'm okay with monthly. I think it gives the fund managers a little bit more time to potentially gain more premium.
Do you say that you would avoid, for you, those ultra high yields like 50 plus 100% yields? You might have a lower yield, quote unquote, lower yield compared to those exotic funds, but you have the upside appreciation and the consistent distribution.
The income investor's perceptive of the growth investor. Typically, most common conversations around an income investor compared to a growth typically is the fact that the growth investor, naturally, all of their return, their total return is locked up in share price for the most part, right? There maybe if it's in an index, there's a very low yield. Who knows if it could be a 1%. But for argument's sake, it's basically all locked up in the price. And the conversation may go like that could get wiped out fairly easily. If it's a bad market, a bad year, 5 years, 10 years, like you're going to be selling off if you need that capital into a bad market, and whereas the income investor can still get some of their return from those premiums generated even in a lower market. But also too, it flips the other way as well. The growth investor can simply say to the high yield investor that like, hey, like you're criticizing me on this, but I understand for the most part that you're getting most of your total return through the distributions itself. You are capturing all downside and no upside when it comes to that natural growth. And if the market goes down, your distributions overall are going to go down with it, even though it might look like, you might look like it's getting paid out and no problem. So it goes both ways. Whereas I am like, kind of look at both sides and I'm like, you know what? I like the growth side. I'm going to take your advice. I'm going to take your advice. I'm just going to smush it together just because I do want to capture upside, because I just have more chances at compounding potentially on a daily basis. But I like the yields. I like the idea of, again, chipping away at my paycheck, compounding, reinvesting, even when the market's flat or not really doing anything. As I often say in my videos, with it being a cover call index investor, I'm really trying to seek the top potential price performance along with the top potential yield, and kind of where is that balance. Now, often I have said it's that I'm finding in my experience is around 10 to 12%, but I do think that's probably a little bit higher now, just because it's reflected in the yield that you just talked about, mainly because I do have other funds that are a little bit more concentrated. They do have higher yields, some sector funds that have some higher yields that have pushed that yield up a little bit more.
Now, Jordan, you made a video titled Why I Don't Invest in MSTY and ULTY. My question is, why don't you invest in MSTY and ULTY? And what are your honest thoughts on YieldMax ETFs? Did you think it was too good to be true? Do you think it's a scam? Do you think it's deteriorating portfolios compared to what you have in your portfolio?
Quick recap on what I talked about in that video. So my theory around Bitcoin, just to keep it short, it doesn't produce anything. I take a very Warren Buffett sort of approach to it, like a farm. It's not a farm. It's not actually producing anything. It's just relying on the excitement. So, I mean, if you buy Bitcoin and you want to sell it, you're relying on someone to be more excited than you to buy it, and so on and so forth. However, when you learn about Bitcoin, the biggest thing, or I should say the first thing you'll probably learn about, is the history of money. When you learn about the history of money, it is so fascinating, and you really start to understand why Bitcoin exists, why it has its place, why we actually do need basically a Bitcoin, or why we do actually need to be on a Bitcoin standard, not as necessarily, I mean, in my opinion, like just something just to trade as an asset, but actually use as a currency in everyday. From that perspective, it's powerful. I'm all for it. I just trade and all that, I'm not really all that for it. However, I have been coming around much more to it. Obviously, it's more stable. There's more adoption, continued adoption all the time. So in my opinion, I don't have anything right now. Don't hold it currently, or MSTY for that matter. But perhaps in shorter order, you might see a small allocation to it at some point. But I'm still reading about it, and I do want to learn more. I don't want to just jump into it just because others have. Then with ULTY and YieldMax and the high yield stuff. Right now, I just think there is just a ton of exuberance around these high yielders. A lot of people just, of course, on Blossom showing off their portfolios and of how it works. And again, it really just comes for the audience. And if you're a newer investor, just understand, just because so-and-so invests in those funds, again, it doesn't make it a bad fund in of itself. It's just that for that person, it might work well for them. I mean, okay, let's just put it this way. If someone is older, investing in, say, an entire YieldMax, portfolio, maybe they're using YieldMax as a replacement for the 4% rule. For those who don't know, the 4% rule just simply is, you're retired, you sell off 4% of your portfolio every year just to live off of. So maybe that's a replacement for them, but maybe they haven't explained it. I don't know. I'm not singling out any one person here. Somebody could maybe get into a YieldMax product as sort of a stopgap. Maybe they've lost their job, but they need income. It's more of a short-term play, but that's kind of like how I see it. It's not a 30-year play, a 40-year play. It's more a retirement play to some extent, a yield booster in some regard. Maybe you really don't care about upside appreciation. Not everybody does. And I think some of that has to do with, again, you're maybe in retirement where your professional advisors would more or less start talking about decumulation in your portfolio. We at our ages, you're 24, I'm 35, we're more familiar with accumulation. That's what we talk about. Growth, compound the growth. Well, when you're getting closer to retirement, yeah, of course you probably don't care as much. You just want to enjoy a life, and YieldMax products could be a good vehicle for that. But as far as actually compounding your wealth, doing it whether through just growth alone on price or just mixing it in, that's where I think people are kind of getting the disconnect and maybe just need to reconsider or just sort of rethink the strategy. I understand getting a big, powerful paycheck every week or every month. That is like an awesome thing. And if YieldMax is your entry into finance, honestly, I don't really care how people get into finance, but if that is your intro into finance, I would just say, listen to other voices, whether it's YouTube, books, podcasts, but listen to other voices. That's what I've done. I continue to do. There are people that, hate cover call ETFs, and sometimes I listen to them as well, just to there might be a perspective I didn't see there before, but as best I can, I don't want to be stuck in a bubble as best as possible. So I think for that reason alone, YieldMax, is it a scam? I mean, look, YieldMax they're doing exactly what they say they're doing. They're trying to get the highest yields possible, pay out the biggest distributions possible. Their mission statement is very clear. They're not hiding the ball on anything. So it's up to the investor to understand what it is, attune their portfolios accordingly. It's like YieldMax isn't, again, they're not hiding anything. And I've interviewed Jay, you have many times, and I've seen Jay on other channels. It's the same message all over the place. I mean, it might be tough, but a lower yield, it would be tough to go from maybe a high payout of 80% down to maybe something in the 15% range. But you never know, your future self might thank your past self in that regard if you're truly looking to compound your wealth over time.
What's your thoughts on NAV erosion? Is your portfolio experiencing NAV erosion? And is that a red flag when you see something like ULTY, something like maybe a yield boost product by Will Ryan? Everybody, we are friends with Will Ryan. We're friends with Jay. Don't think like we're trying to hate them. But when you look at those charts, you're seeing just the share price just go down and down and down and down and down.
Let's talk about, maybe what is NAV, net asset value. You take like the AUM divided by the units outstanding. That's how you get the NAV unit price. Cover calls, cap upside. That's fairly well known in this circumstance. But of course, you never know who's tuning into a video like this who might be a newcomer. So if you didn't know, cover call strategies, cap upside, it can vary depending on how these call options are written, but they cap upside. So for any basket of stocks or maybe a one or even a single stock, there's only so much growth it can capture, right? It hits that ceiling pretty closely. However, the downside, it's like a black hole. There is no potential end to it. So that's why for me, having a mix of both is really critical, because my upside's capped. If I'm receiving everything through the distribution, it's capped. You're basically going to trend like this. More specifically, Granite shares with their products, the yield boost products. I mean, they're writing their call options on daily leveraged ETFs. So if you're a buy and hold investor, and this is something that I have asked Will myself, is that my audience is typically a lot more buy and hold. So, and he even said these products wouldn't really fit that profile, because with the yield boost products, I just see them more as real short-term plays. If you're into a dividend capture strategy where, you buy something the day before ex-div, you sell it on, the ex-dividend date. Maybe you use some sort of hedge in there just to try to make up for the fact that typically the ETF will drop in whatever the distribution is going to be on the ex-dividend date. So maybe in that sense, a yield boost product might make a little bit more sense in your portfolio. But again, I just see it more as like a trading vehicle, not a buy and hold vehicle. Whereas YieldMax, I do see more as you can buy and hold it. I see it more in that light. I don't see it as a trading product, albeit it can be. And we know people like Todd who use like YieldMax products as a trading vehicle, but does sort of or can hold some of this stuff for a longer term play. I think for a vast array of investors out there, honestly, if you got other things you're pursuing, you want to maybe try to grow a side hustle, a business, but hey, you still want to be able to invest, kind of grow your money passively.
Let's talk about recession, stock market crashes. The critics would say, I can't wait for a stock market crash because these cover call investors are going to get destroyed. So what are your thoughts on that? And how will you react with your portfolio in a recession?
I mean, Marcos, we've gotten a little taste of that with the Liberation Day stuff. It was a correction. Corrections typically happen every year between 5 and 10% roughly. This one was a good one though. And I think it was, in a way, oddly to say, not that I was rooting for it, but it was probably a good wake-up call for a lot of investors, as downturns typically are. You see rotations into different sectors. But I mean, like you said at the top of the video, Marcus, my portfolio is basically at all-time highs. It didn't matter that event happened. Like, to me, Liberation Day is an afterthought because, once again, I'm trying to get that maximum price appreciation and then get that maximum yield that I can then reinvest. So regardless that happened, my portfolio still recovered and is at an all-time high, and my portfolio is the biggest it's ever been. I understand I sold my house, and I don't want that to be a skewed thought for the audience, but then again, there's nothing down in the portfolio right now. Maybe my energy position might be the only one that's down that I've had for, the past couple of months, but everything else is at an all-time high for me that I've never seen before. So in an actual crash, obviously, I thought about that a long time ago, and I do think my portfolio will weather that storm. I will simply reinvest. I will still keep buying the indexes because I still believe the market is still going to recover. If you don't believe the market's going to recover, I mean, then maybe guns and coffee might be your avenue for investing. But for me, I'm going to stick with my ETFs because I do believe that they have the potential to recover, and I'll keep reinvesting in them as we see fit. Utter confidence in that. There is no hesitation in the back of my mind when you ask that question, Marcos. None whatsoever. I think that this portfolio can ride the storm, and I can still be fairly hands-off with it. Maybe there's other opportunities I see, and I would maybe change something just to maybe try to capture more potential upside in that event. But regardless, even if things stay the same, I think that it would recover, and I've seen it.
So you want to retire by age 45. Now, how much money do you want to have in your portfolio as a balance, and how much income do you want your portfolio to generate you on a yearly basis?
I picked 45, not as the earliest, that's the latest. I chose that number because I have my two sons will graduate around that age. My one son will graduate when I'm 44. I have another son that will graduate when I'm 46. Why did I pick 45? It really wasn't portfolio size. It had more to do with if they weren't really sure what they wanted to do, that maybe I'd try to get them into, an equivalent trade, maybe, come work with dad, essentially. So that's how I kind of thought of it. They can do whatever they want. That's fine. It's just if they're really not sure, don't really have much of a plan, aren't too interested, then I would kind of maybe try and help shepherd them along in that regard, and maybe get them working with me. I'd probably have maybe a $2 million portfolio by then. I think my distributions by that point, if I was to do 45, would probably be in the $40,000 range, maybe, off the top of my head. Yeah, a month, $40,000 a month. So probably it could be very well in that range. And I'm just guessing off the top of my head here. It's a huge range. Regardless, if I step away from my working job, I want to be able to reinvest at least 1/3. So the way I've been thinking about is between about 30 and 50% being able to reinvest. I don't simply just want to get to replace my paycheck and therefore I just walk away. I always need to be reinvesting, and I want that in place in case of any shocks in the economy where distributions could potentially get lowered. With a balanced strategy, actually, you're giving yourself more chances at distribution increases, actually. Increased volatility, tied to price. As prices rise, you also can give yourself a little bit of a natural raise as well. So if I hold these funds for a couple of decades, that yield on cost could look even bigger than a YieldMax yield, which is kind of funny to say. That would be a really, really long time. But for the audience to think in the most easiest conceptual way to think about that, if you get a distribution and your share price is like $10, but it pays out $1, well, as the natural distributions increase, it's getting closer and closer to your book cost, which is the $10. Once your distribution hits $10, you're at a 100% yield. Allowing your distributions to have that ability to grow as well could, in theory, get you to outpace YieldMax eventually. With YieldMax, you're starting on the up end, but you have more downside potential with those yields. So just keep that in mind.
From a risk scale of 1 to 5, what risk is your portfolio from 1 to 5?
It would probably, I'm just going to say a 2. I'll just say a 2. Cover call ETFs do lower a little bit of volatility. They do. My money's in the markets. It's invested in indexes. So as long as I'm fairly tied to the economy, and because it does lower volatility, I think the risk level is kind of more down there. I don't think it's at a 3. I don't see it like that. Again, indexes, you're investing, keep it fairly simple. And I think the risk level becomes probably a little bit lower on that end. But I don't think it's a 1. Let's just say 2.
What do you prefer, dollar cost averaging or lump summing?
Lump sum investing, long term. As far as performance is concerned, it's better. However, don't forget the mental aspect and so the peace of mind aspect. Dollar cost averaging is probably just better that way for you. So I'm going to go with dollar cost averaging. As soon as I get distributions, I reinvest them immediately.
Is high income, passive income, or should I say cover call ETF investing underrated or overrated?
It'd be weird for me to say overrated, but certainly underrated. If you really don't know and you've maybe just read some vague talking points about it, and I often read these vague talking points in articles that are, by authors who have maybe asked ChatGPT or done a quick Google search that they need, right, just to quickly write something out. So I think once you go deeper into it, you, like all things, you kind of discover the gold nuggets within it, and then the potential of like what that can mean for your lifestyle. The cover call ETF strategy is not just an investing strategy, it's a lifestyle strategy as well.
What are some key takeaways or some not financial advice for investors who are beginners who want to dip their toes into cover call ETFs and passive income investing?
First and foremost, it's just listen to the voices, whether it be us, follow our channels, follow as many channels as you possibly can. You're going to find out fairly quickly kind of who you more or less attune to, who you're interested in. I didn't have any recommendations, and then as far as the investment side of things, if you were like, I started listening to guys like Graham Stefan, Andre Zick, Brandon Beavis, Adrian from Canadian T-Shirt. But what was the thread that attached all these guys? They were all indexed to the S&P 500. There is like sort of a common strategy or a core strategy that people like the big YouTube influencers seem to invest in. And those are those passive indexes. And of course, for cover call ETFs, there is a tremendous array of strategies that allow you to get that exposure. So if you don't know anything and you just maybe want to get your money working for you right away, even if you don't know these things, I mean, that's maybe just something to take to heart, whether it's a S&P 500 fund or maybe a NASDAQ 100 fund that maybe doesn't have cover call writing on it, or maybe it does. Those are great points. And at least you get your money growing, you can start learning, and you can have at least the confidence that, hey, I have all these companies in this ETF, and yeah, I'm going to learn along the way instead of maybe just copying whatever you see on social media. Stick with some maybe boring stuff to start with, and then maybe rev up from there as your education compounds. Honestly, that's what I found as I've gotten more educated in this stuff. It's a weird phenomenon, but it's almost like the portfolio is like moving in conjunction with your education to a degree. I got some theories around that I've heard about, but that's what I have found. Increase your education. Education equals amplification in your portfolio as well.
Now, I would love you to plug in your channel and even talk about very briefly your own cover call ETF All-Star Tracker, which is one of the best in my opinion. I'm not getting paid for this. I'm not getting compensated, but I would love for you to talk about your tracker as well as to plug your YouTube channel.
Maybe you're just curious, then you can just follow me at Cover Call ETF Investing. I do videos every Sunday. They come out at around 9 a.m. So one video a week. So you're not going to get oversaturated by this face. I do it that way because, again, time constraints, but I still very much have a deep passion to talk about finance, and talk about portfolio overviews are quite popular. There's just so much. I don't even know where to start as far as like the actual, how do I look into funds? Sure, I could Google search it, but I just need like one location where I can have like those eureka moments. Like I created a Google sheet that encompasses 300 funds across Canada and the US, and I've kept them separate. So you'll have a Canadian tab, you'll have an American tab, but it doesn't just end there. There's performance data that's live. The yields that you look at are live as well. So as you see fluctuations in the market on a minute by minute basis, those yields actually change based on forward looking yield. So I do this on an almost daily basis, but you're only limited with the All-Star Tracker with what you can think of as far as, can the tracker do this? And then sure enough, guess what? It can do it as far as getting your information. So it's a quick way. It's about $50 for the year. You'll get basically an updated tracker every single month on the 1st of every month. And yeah, quite proud of it. I've put a lot of work into it. I always have to put work into it at the end of the month to get these updates out, to record distributions, record AUMs, and the like. But some great stuff in there if you want to learn about taxes and everything Cover Call ETF related.
Now, if you guys like this video, please give it a like because this cute puppy did. And don't forget to check out our last interview right here on your screen. I love you guys so much. Crushing the stock market, and take it easy. Peace.